Hello dear friends, I am Sanjay Harimani, Assistant Professor of Commerce, Department of Collegiate Education, presently working in Government Postgraduate College, Hospandi Harlapur, Taluka Industry, Koppala. In this session, we will discuss and study on an important chapter of BCom 6th semester Management Accounting, that is Fund Flow Statement, Theoretical Aspects. The scheme of presentation, meaning of fund and flow, objectives and limitations of fund flow statement, comparative study of fund flow statement with various financial statements, sources of information for the preparation of fund flow statement, schedule change in working capital, computation of funds or a loss from operation, preparation of fund flow statement, important adjustments and their treatment, and a problem on identification of source and application of funds or the items to be added or deducted while computing funds from operation. Meaning of fund. In a narrow sense, fund means only cash. Even a layman can use the word fund. We have heard many times the people used to say there is a shortage of fund or an excess of fund. They restrict the word fund to the cash only. But in broader sense, fund refers to all financial resources of the firm, not only cash. Other than cash, even the stock of goods, the amount receivables, or the bills accepted, all have become the financial resources. In accounting sense, we can say the fund represents the net working capital, that is the excess of current assets over current liabilities. Friends, you are very much aware about the current assets and current liabilities. Current assets are the assets which are used for a very short span of time, that is within 1 year, and current liabilities are the obligations. They are to be payable within 1 year. So the term flow means, in general, flow means moving or not constant. Therefore, flow of funds means a movement in net working capital. That's nothing but either increase or decrease in net working capital. Increase in working capital happens to be either increase in current assets or decrease in current liabilities. A decrease in working capital happens to be decrease in current assets and increase in current liabilities. Here you have to note certain points. Flow of fund takes place only when a transaction affects the current category and other non-current category. If the transaction affects both the current or both the non-current category, then there is no flow of fund. For example, cash paid to creditors. Here the transaction affects cash balance and creditors balance. If cash comes under current assets. Creditors comes under current liabilities. Cash decreases and creditors balance also decreases. So here the ultimate effect is the current assets decreases, current liabilities decreases with the same amount. Then there will be no flow of fund. Similarly, there are certain transactions which affects both the category, both which affects same category, current, current or non-current, non-current, non-current. Then there is no flow of fund. So the definitions given by various authors on fund flow statement by Robert and Anthony. Fund flow statement describes the sources from which additional funds were derived and uses to which these funds were put. The definition clearly states that fund flow statement is the statement that is used to know the sources and application of funds, or from where or from what source the funds raised and for what purposes the funds were utilized. The Institute of Chartered Accountants of India gives the definition: statement of changes in the financial position summarizes for the period covered by it the changes in the financial position, including the sources from which funds were obtained by the enterprises and specific uses to which such funds were applied. So fund flow statement is prepared for a specific period, including the sources and the uses. Objectives of fund flow statement: to disclose change in flow of funds, either increase or decrease in working capital. Working capital plays very important role for the business organization. It's the capital which is required for the day-to-day operation. There should not be either more or less working capital. Both disturbs the organization, so it is necessary to know the increase or decrease in working capital from one period to the another period. For that purpose, we need to prepare fund flow statement. The second objective, to identify the sources and application or uses of funds. It's quite essential to know the origin or the source of fund, from where the funds are raised and for what purpose the funds are used. It helps for the allocation of resources. The next objective, to determine the financial consequences. Fund flow statement helps to identify the various uses and sources of funds. It helps the management in finding the financial consequences and taking the precautionary measures. It serves as a tool for evaluating effective use of working capital. It clearly states, fund flow statement clearly states the sources and application that helps the management to make the best use of available working capital. Lastly, it enables the management in formulating sound financial policy. Limitations of fund flow statement. First one, it ignores certain non-fund items which are equally important on financial position of the firm, like issue of shares in consideration of purchase of assets. Fund flow statement is purely based on fund items, but there are certain things which are essential in the organization and influential in decision making, but they are not considered. Second limitation, it reveals change in working capital and not change in cash. There may be a situation firm may have sufficient working capital but may not be in a position to meet its current liabilities due to shortage of cash. As we discussed, this fund flow statement includes all the financial resources, not only the cash. That is, it considers net working capital, that is, the excess of current assets or current liabilities. Here, cash is one of the item of current asset. So, the firm may have a better working capital but may not have a better cash position. Third objection against fund flow statement. It is historical in nature and it is quite difficult to predict the future. Fund flow statement is based or it is prepared on the basis of last 2 year balance sheet and current year profit and loss account. It means it is historical in nature. And with the past information or with the happened information, it's very difficult to predict the future. The fourth limitation, it's not an original or a primary statement as it is prepared with the help of 2 years balance sheet and current year profit and loss account. It's not an original or a primary statement like the income statements or the position statement. Here one thing you have to remember, fund flow statement is a mandatory for all companies except private company with a paid up share capital less than 50 lakh or such higher amount as may be prescribed but not exceeding 5 crores or with a turnover of less than 2 crores or such higher amount as may be prescribed but not exceeding 20 crores. It means there are certain companies for them it's not mandatory the preparation of fund flow statement. Fund flow statement versus income statement. Here the points of difference is, first point is the nature. The income statement nature is quite different from the fund flow statement. Income statement is prepared with an object of knowing the income or loss. Fund flow statement is prepared with a motto with an objective of knowing the position, working capital position of the enterprise. Income statement is prepared by all the organization, whereas fund flow statement is prepared by all the companies except private company with a paid up share capital less than 50 lakh. The third point, help. The income statement is prepared with the help of trial balance, adjustments, and fund flow statement is prepared with the help of 2 years balance sheet and current year profit and loss account. Items in income statement, we consider all revenue items. Capital items are not at all considered, but whereas fund flow statement, both revenue and capital items are considered. Income statement is compulsory for all companies, whereas fund flow statement is an optional. The scope of income statement is greater than fund flow statement. Now we'll discuss on fund flow statement versus position statement, that is balance sheet. Nature, balance sheet or the position statement is the summary of assets and liabilities. Fund flow statement is the summary of fund items. Fund flow statement is used in management accounting, whereas position statement used in financial accounting. Basis of preparation: position statement prepared with the help of trial balance and adjustment, and fund flow statement is prepared with the help of 2 consecutive year balance sheet and income statement of current year. Position statement includes the capital items. Fund flow statement includes both revenue and capital items. It is mandatory. Position statement is mandatory. Fund flow statement is optional. The scope of fund flow statement is limited. Its usage is limited to the management, whereas position statement, its scope is wider as it is required by all organizations and used by all the stakeholders. Sources of information for the preparation of fund flow statement, as we have discussed earlier, 2 consecutive years balance sheet and current year's income statement. The steps are: there are 3 steps in the preparation of fund flow statement. It's a very interesting one. We can prepare the fund flow statement by seeing the current category and we get the answer, increase or decrease in working capital. On the other way, we can prepare the fund flow statement by seeing the non-fund items, and there also we get the increase or decrease in working capital as our final answer, and we can cross verify the correctness of the preparation of fund flow statement by comparing both the answers. First, we have to prepare the schedule of change in working capital and ascertainment of funds or loss from operation, and third, preparation of fund flow statement. The balance sheet is seen clearly in 2 segments, that is current and non-current category. Problem whether correctly solved or not is cross-checked in case of fund flow statement. So, as per the New Companies Act, the companies have to prepare the balance sheet in a vertical format, and there it is clearly mentioned the current assets and current liabilities. Here we have to understand that the balance sheet in 2 broad categories, current and non-current, both in case of assets and liabilities. The first important step in the fund flow statement is the preparation of schedule change in working capital. See the structure of or the specimen of schedule change in working capital. Particulars, quite bigger column, previous year, current year, amount column. Then effect on working capital divided in 2 parts, increase in working capital and decrease in working capital. this the shape of the schedule change in working capital should be properly managed. In particulars column, we begin with current assets. I have written here examples. There we can write cash, bank, debtors, bills receivable, other current assets. Then total of current assets. If you see the balance sheet, last year balance sheet and current year balance sheet, if it is in the vertical format, current assets, that's separate head would be there, and from that head all the current assets are to be taken here as it is, and total of current assets. So previous year and current year, the amounts you have to take. Suppose the cash in previous year 5,000 and current year 7,000, so 2,000 increased. So what is the effect on working capital? The current assets increases means the working capital increases. Current assets decreases means there is a decrease in working capital. So the current asset shows a direct relationship with the working capital. So if it is increased, write in increase column. If it is decreased, write the net increase or net decrease in a particular column. Similarly, B, write the head current liabilities. Examples, you have to take the examples: bank overdraft, short-term loans, creditors, bills payable, etc. As they have given even the provisions in the balance sheet, they will be giving the current liabilities in a particular head. They are to be copied here. Previous year amount I have written in previous year column. Current year amount you have to write in current year column. Increase or decrease in working capital. Current liabilities increases, that is a decrease in working capital, and current liabilities decreases, that's an increase in working capital. Here you have to be very particular because the current liabilities shows inverse relationship with the working capital. Current asset shows direct relationship and current liability shows inverse or an opposite relationship. So current liabilities increase, it means decrease in working capital, and current liabilities decrease, that is increase in working capital. Next, net working capital. So I have written there A minus B. So total current assets A, total current liabilities. So the previous year column current assets minus previous year current liabilities, you'll get net working capital. Similarly, current year current assets minus current year current liabilities, you'll get net working capital of that year. So increase or decrease, here you just write the total. In increase in working capital and decrease in working capital, just write the total as usual, means total increase in working capital and total decrease in working capital. Leave one or two line space, down you write a grand total. In grand total, the greater total will be written. Suppose net working capital in previous year is 50,000, current year is 70,000. So in grand total, you write 70,000 in previous year and current year column. Then you have to find the difference. How you do in ledger account? The balancing figure comes, and that balancing figure, here I have given an example 50,000, 70,000. So 20,000 you have to write in previous year column, and that is increase in working capital, because last year it was 50,000, in current year it is 70,000. So 20,000 is increase in working capital. That is the balancing figure. Suppose it is 30,000 and 20,000. So 30,000 minus 20,000, that 10,000 is net decrease in working capital. So this is the basic thing you will understand. Similarly, here in increase and decrease working capital, you write the grand total, write the missing figure in the column. So here you have to remember the amount you write in increase in working capital, that is nothing but the excess of decrease over the increase in working capital, and you have to write amount comes in increase column, but you have to write that is a decrease in working capital. If the amount comes in decrease, that's an increase in working capital, because it's like a ledger account. You have done the balancing over here, and that shows, suppose the amount is in increase here, it shows the decrease total is greater than increase. So the important note here in the schedule, increase or decrease in working capital is a balancing figure. If it is on increase column, it indicates decrease in working capital, and if it appears on decrease column, it is increase in working capital. This is the very simple and interesting concept of fund flow statement. Here you just take the figure from the balance sheet, present in the format current assets, total of current assets, current liabilities, total of current liabilities, then net working capital, finding the increase or decrease in working capital. And be particular about the size and shape of the column. Previous year and current year amount column should have an equal width. Effect on working capital, in that you write increase in working capital or decrease in working capital. That should have a equal width. I suggest take the previous year first, so that you can easily compare with the current year, increase or decrease. If you take current year first and previous year later, then there may be some confusions. So this is my suggestion, and anyhow you can, there is no any strict rule, you can interchange the previous year and current year. Second important step in the fund flow statement, preparation of funds from operation. What is funds from operation? The net profit shown by the income statement is not straight away known as funds from operation. Income statement considers various non-fund items. Such non-fund items are to be adjusted to know the funds from operation. See the format of funds from operation. The left hand side, a small margin is to be kept to write add or less. Particulars, quite bigger column, one inner amount column and amount column. It begins with net profit as per the income statement. Add non-fund items debited to income statement. These are added because these are non-fund items debited to profit and loss account. Because of that, the profit is showing less. Now we have to add it back. So the non-fund items, first one is depreciation. and amortization of fictitious assets. Second, non-trading losses like loss on sale of fixed asset, loss on sale of long-term investment. These all are debited to profit and loss account, now added back. Third one is appropriation of profit, like transfer to general reserves, transfer to other reserves. The company can make various reserves, and the certain amount of the profit is to be transferred to the reserves. To that extent, the company is showing lesser profit. Payables or a proposed dividend, provisions for taxation. These are the items debited to P&L account, now are to be added. So we have to find out these items from the income statement or from the adjustments, and we have to add back to the profit. So net profit as per income statement, adding non-fund items, total, then less non-fund items credited to profit and loss account. These are credited to profit and loss account. Because of that, the profit is showing more. Since they are non-fund, they are not supposed to be credited. Hence now they are deducted. For example, profit on sale of long-term investment or profit on sale of asset, appreciation in the value of asset, a retransfer of excess provisions, decrease in the value of liabilities, profit on sale of fixed asset, etc. These are also to be found from the income statement and adjustments, and accordingly deducted, and after that we'll get the answer, that is funds from operation. If it is positive, if the answer comes in positive or plus, it is called funds from operation. And after doing this add and less, if the answer is in negative, it's called as loss from operation. If the answer comes in negative, it is called loss from operation. If net loss is given in the question, it's a very important thing. The format is begins with net profit as per income statement. Suppose there is a net loss, then use the same format. Replace the add with less and less with add. Interchange add and less. Or another option is given. Loss is there. Put the sign minus over there. Minus, then you have to add it. So minus, and you are adding that adjustment, less is there. Then lastly you'll get the funds from operation if it is in positive. So there are two ways. You keep the same format. Loss is there, just put a sign minus, and add is add, less is less. Or don't put the sign minus for loss. Add, you make it less, and less you make it add. And last final, if the answer is in positive, it is funds from operation. If the answer is in negative, it is called loss from operation. This is a very important element in the preparation of fund flow statement. Third step and the preparation of fund flow statement. It is prepared by taking into consideration only non-current assets and non-current liabilities of the previous year and current year balance sheet and income statement of current year. So the fund flow statement, while preparing schedule change in working capital, we have not touched the non-current category of the balance sheet of both previous year and current year. But while preparing fund flow statement, we will see only non-current category non-current category of the balance sheet of both previous year and current year. See the format. It's like a balance sheet. Your left hand side shows sources of funds and right hand side application or uses of fund. Amount column. The first important element you have to write funds from operation or loss from operation. Funds from operation is a source of fund. Write it in the source column that you have already calculated. If there is a loss from operation, write it on the application of funds. Now, see the balance sheet. Non-fund items first, share capital. It may be equity shares or preference shares. See the previous year amount and current year amount. If it is increased, it is a source of fund. Right on the sources side, issue of shares may be equity or preference, and write the net amount of increase. Suppose there is a decrease. Last year it was 10 lakh. This year it is 8 lakh. It means 2 lakh is a decrease. It means the repayment of share capital or a redemption of share capital. Write it in the application of funds or on the right hand side. Take the net decrease. Similarly, issue of debentures. Issue of debentures is a source of fund. So to see the debentures, balance increases, take it on the source side. Balance decreases, it means the repayment of debentures. That is an application of funds. This all comes under non-current categories. Share capital, then long-term loans. Long-term loans, same. If it is increased, it is raising of long-term loans. Right in the source side. If it is a decreased, it is a repayment of long-term loans. Write it on the application of funds. So this is very important. You can see only non-fund, non-current category. You can see only non-current category of the balance sheet. Next, sale of fixed asset or the purchase of fixed asset. Here you need to prepare the fixed asset account. Ledger account you have to prepare. There you will come to know the asset is purchased or sold after considering depreciation. Whenever there is a change in the fixed assets amount from the previous year to the current year, it's better to prepare that particular asset account. Write the depreciation amount. Then the difference is the sale or purchase of fixed asset. If it is a sale of fixed asset, it is recorded. It is a source of fund and recorded on the left hand side. And if it is a purchase, it is an application of fund recorded on the right hand side. Non-trading receipts and non-trading payments. Non-trading receipts like dividend received, refund of tax, rent received. Such items are treated as a source of funds. These are not the incomes generated out of operating activities. Similarly, non-trading payments like provision for tax, proposed dividend, that's non-current liability, and their payment will be application of fund. But if only a provision has been made for tax and a dividend, it will not be an application of fund. So after considering these all items, non-fund items, sources and application, you have to do the total and the difference or the balancing figure. It may be on left hand side or on the right hand side. If the application side is greater and the balancing figure comes on sources side, it's called decrease in working capital. Decrease in working capital is not a source of fund, it is an application of fund, but still shown on the sources side because it is a balancing figure. Like in balance sheet, how you'll do it. Suppose the balancing figure comes on application side, it's called increase in working capital, and that's nothing but the excess of source of funds over an application of funds. Students may ask a question, source of fund is a source of fund sorry students may ask a question, increase in working capital is a source of fund, but why you have to write it on decrease in working cap? Why you have to write it? Sorry, there may be chances the students get confused that decrease in working capital is shown on the source of funds. We should convince them that it is a balancing figure. It indicates that application of fund is greater than the source of fund. Similarly, increase in working capital is a source of fund but shown on the application of funds because it is a balancing figure indicating the source of funds are greater than the application of funds. We'll move to the next very important aspect, treatment of important adjustments while preparing fund flow statement. Provision for taxation. As per New Companies Act, it is treated as a current liability and hence recorded in the schedule change in working capital. So provision for taxation is a current liability. Since it is a current liability, it is taken in the schedule change in working capital in current liabilities category. If it is increases, that is a decrease in working capital, and if it is decreases, it is an increase in working capital. Second one is proposed dividend. It is also considered as a current liability as per the New Companies Act, and the treatment is same as provision for taxation. Interim dividend. Interim dividend is the dividend which is declared or paid in between two annual general meetings. The board of directors have the power to declare the interim dividend, but not paid out of the capital. So the treatment in fund flow statement about this interim dividend, it is added to the profit while preparing funds from operation and also shown on application side of the fund flow statement. So interim dividend has two effects here. It is a non-fund item debited to profit and loss account, hence it is added to the profit while computing funds from operation, and it is paid to the shareholders. It is an application of fund shown on the application side of fund flow statement. Provision against current assets like RDD. Here there are two options. Sometimes in the balance sheet we'll see the debtors inner column minus RDD, reserve for doubtful debts or provision for doubtful debt and bad debts. The amount will be given and net amount will be taken in the outer column in the balance sheet of previous year or current year. In this case, if you have taken the net amount and then RDD, here the students can take net amount directly in current assets, debtors, net amount you have to take, then accordingly increase or decrease you have to write. Or current assets column, debtors, you take the gross amount and accordingly increase or decrease you have to write. And that RDD, that provision is there, you have to show it in current liabilities, previous years and current years, and there also increase or decrease you have to do it accordingly. It's better that I suggest you take the gross amount and RDD, show it in the current liabilities column, or for simple calculation just take the net amount in current assets. Correct. Investments, temporary or short term, are taken to settle change in working capital. Medium and long term are shown on fund flow statement, either source or application. So investments, if in the balance sheet or in the position statement, the investments particularly mentioned temporary or short term, they are considered as a current asset and recorded in schedule change in working capital. If nothing is given or particularly long term is given, assume that it is fixed asset and considered in the preparation of fund flow statement. If it is increased, it is called as purchase and recorded on the application. If it is decreased, considered as a sold, recorded on the source side of fund flow statement. Fixed assets like land, building, machinery, furniture, equipments. It's better to prepare fixed asset account to know whether assets are purchased or sold during the year. It should be noted that asset shows debit balance, depreciation is recorded on credit side, profit on sale of asset is recorded on debit side of the asset account, and loss on the credit side as P&L account. So all the assets shows debit balance, you write to balance brought down, previous year balance, by balance carried down, current year balance, by depreciation on that asset, and by P&L account to P&L account. If it is profit, it comes on debit side to P&L account, bucket in bracket profit on sale, by P&L account in bracket loss on sale, then the difference is the asset purchased or sold, and accordingly it is recorded in the fund flow statement. Don't take directly the difference. Fixed asset machinery 1 lakh entry, ending balance is 1,20,000, is not net 20,000 is a purchased because there is a depreciation. It's better to prepare fixed asset account separately. Next, premium on the redemption of preference shares or debentures. It is calculated and added to the profit while computing funds from operation and also shown in fund flow statement as an application of fund. Preference shares are the shares which carry preferential right over the equity shares. There are certain types of the preference shares. Sometimes preference shares are to be repaid at premium, means more than the face value. In that case, that premium amount premium amount should be calculated and added to the profit because it is a non-fund item debited to P&L account, now added back to the profit while computing funds from operation. Since you have paid it, it is an application of fund and also recorded on the fund flow statement. Same case with the debentures. Debentures are issued at par or discount payable on premium. That premium amount is to be calculated and added back to the profit as non-fund items debited to P&L account and also shown as an application of fund in preparing in fund flow statement. Non-trading receipts, as you have seen in the specimen of fund flow statement, such as dividend received, refund of tax, rent received, etc., are the source of funds and shown on fund flow statement. If these are credited to income statement, very important thing, if these are credited to income statement or deducted from the net profit while computing funds from operation. Issue of bonus shares. If issued out of the capital redemption reserve, share premium, general reserve, P&L account balance, then there is no flow of fund and hence no need of any adjustment in while preparing fund flow statement because the bonus shares are issued by subtracting, by deducting the various reserves. Reserves reduced, share capital increased. Both have the non-current category. There is no flow of fund. Next, purchase of business. Here, change in fixed asset is either purchase or sale and recorded accordingly. Change in fixed assets. If it is more, purchase. If it is less, it is sale, and hence it is recorded in fund flow statement as a source of funds and application of fund. And change in current assets from the issue of share capital is a source of fund in case of purchase and application of fund in case of sale of current asset. There is a small problem. On theoretical aspect of fund flow statement, theory plays a very important role while solving the problems. If you are perfect in theoretical aspect, it will help you in solving the problems easily. So here is an attempt to identify the following items as an inflow and outflow of funds. Randomly I will check. First one, increase in working capital. It is a source of fund, but you remember increase in working capital in the specimen of fund flow statement we have shown it on application side because it is a balancing figure that shows excess of sources over the application of funds. Eighth one, interim dividend. Interim dividend is an application of fund. Payment of tax, 18th one, is an application of fund. Sale of plant, 15th one, is a source of fund. Go through all the 19th one. I have given the answer. S stands for source of fund. A stands for application of fund. The second one, identify the following items, whether added or deducted from net profit while computing funds from operation. Depreciation is a non-fund item added back to the profit. So I have shown the answer here. Plus discount of the issue of shares on or on debentures. Discount on the issue of shares. It is a non-fund item, but it is debited to profit and loss account, hence added back. Loss on revaluation of asset. It is non-fund item debited to P&L account, added back. If it is a profit, it is to be subtracted. Overvaluation of stock, very important. Overvaluation of stock. If you overvalue the stock, the profit would be more, and to that extent, to the extent of the overvaluation, you have to we have to add. Fourth one, little bit confusing. Overvaluation of stock. It should be add or less, depends on the opening stock or closing stock. Overvaluation of opening stock, added. Overvaluation of closing stock is subtracted. You just think of the trading account and its effect on net profit. If the net profit increases because of the overvaluation, now we have to less it, so we have to minus. If the net profit decreases, we have to increase it. For that we have to add it. Appreciation on assets. Asset value is showing more. It is to be minus. Premium on the redemption of debentures, preferences. It is recorded in the income statement, recorded on the debit side of the income statement, and hence it is to be added back to the profit. Similarly, pre-acquisition, dividend received, undervaluation of stock, preliminary expenses written out are to be adjusted while preparing the funds from operation. These are the certain examples. When we solve the practical problems, these items, we have to be very much careful. Very much careful while dealing with these items. Thank you. With the best wishes. If you have any difficulty, you can mail me or you have the contact number. Kindly go through the slides and give suggestions for the betterment. Thank you, one and all.